That 4.3 trillion is the amount of cash sitting in money markets around the world, just collecting virtual dust. That could be a big time boom for equities if even some of that started to come into stocks. Do you expect that to happen?
I do expect that to happen because if you look at the actual numbers, there's $700 billion in cash more today than there was in February. So overall, investors have been fairly cautious. Now, sentiment recently has gotten very, very optimistic. So that suggests we may have a pause coming. But nevertheless, there's fuel here, and there's fuel for another leg higher. We do think the short term will be what we call the air pocket. COVID slowdowns, California's 9% of US GDP. So there is going to be some effect in the real economy as COVID spreads before we fully vaccinate people. So it's just, I can't imagine the market ignores that forever, but there may be a moment of truth. The S&P is trading 16% above its 200-day moving average, and I would look to there for where we might consolidate.
Yeah, we talk so much about historical trends, 13 out of 13 times with this setup coming into December. The S&P has risen in December, the so-called Santa Claus rally. But here's the thing. Santa Claus didn't have to deal with COVID.
Very true. Look, I think that some of December's returns may have been pulled forward into November as we got week after week of positive vaccine news. What we really need to see here is a lame duck stimulus bill to really keep this going. So last week, I upped my percentage probability of whether or not we were going to get a lame duck fiscal stimulus bill. I think we might. I think we can do that. I think that the labor report, the jobs report on Friday, was a rude awakening to the fact that the expansion is slowing, and there's some risk we lose jobs in the next report as economies in the U.S. are closing. So that I think there's fire under the feet of Congress, and I hope they take the bait and run with it.
When we look inside the markets, it's your data. I'm going to use your words back to you, Alicia, just because it makes me sound smarter. 63% of the S&P 500, their dividend yields are trading above the 10-year yield, although 10-year yields have creeped up just a bit. I mean, is that sort of income opportunity there from some of these companies going to be the hook that brings people back in? This idea of TINA, of course, there is no alternative. Is there some more fundamental reason to own stocks other than, well, this gets me more than that?
Well, right now we think the bond market is very expensive, even with yields moving up in the last few months. So given that dividends are higher in the S&P, we like stocks for TINA for the fact that there is no alternative. There are other options besides global fixed income where you can get some return. It just doesn't feel like the risk reward profile here is very positive. If we get stimulus, and we can look to the second half of 2021 as being a much better time and a much stronger period of growth, the sovereign debt profile may not look that great.
Are you on this small cap train that we've been talking about so much the last couple of months, Alicia?
I am. I'm on the small cap train. That's what performs coming out of a cyclical recession. We're getting cyclicality in next year, and that's why small caps are performing.
Shepard Smith here. Thanks for watching CNBC on YouTube.